Real estate isn't just about finding a good deal. It's about finding the right deal in the right market. Buy in the wrong neighborhood and you end up with a property that sits vacant, drains your cash flow, and tanks your returns. But when you learn how to analyze a market like an investor, you unlock the ability to spot high growth areas, avoid hidden traps, and most importantly, build long term wealth like a pro. Today, we are breaking down the full real estate buying process. I'm going to be deep diving into what makes a good market. You're going to learn how to spot job growth, population trends, school ratings, etc. We're also going to talk about how to research like a pro. I'll show you the exact tools and resources to validate whether an area is worth your time and, most importantly, your money. We're also going to talk about where to find the right deal. Is it the MLS? Is it off market? Is it a wholesaler? Is it an auction? It's really important that you understand your deal source and that you make sure that that deal source actually fits your goals. We're also going to talk about key investment metrics that really matter. We'll break down the 1% rule, cash on cash return, and other metrics that separate smart investors from risky ones who are just kind of making decisions off the fly. Along with all of these strategies, we're also going to talk about how real estate pays you, risk management, and a little bit of property management strategies. By the end of this video, you'll feel clear on what to look for before buying your first or next property. You'll feel confident in your ability to spot high growth markets, and you will also feel empowered with the right tools to validate and not just guess. But most importantly, honey, you will be prepared to win because you are not buying blindly. If you, my darling, are serious about winning in real estate and not just hoping that your deal works out, keep watching because we are going to break it all down so that you never waste money on the wrong property. Welcome to Lessons Lived, everybody. My name is Nandy. If you are new here, I'm so glad you found this place. Ours is a community of women who are ambitious and women who take action. We leverage our full-time jobs to build scalable side businesses because we know that wealth isn't an escape plan, it's a power move. Your 9 to 5 is your launching pad. If you are ready to turn your career into capital, your expertise into income, and your business into a legacy, you are in the right place. Today, we are talking about how to find the right deal. Before you buy your property, you need to understand your market. Think of it like grocery shopping. You wouldn't buy the first apple you see, would you? You check for the freshest apple. You would check for the best price. The same goes for real estate. A great deal in the wrong market can quickly become a bad investment. Trust me. Right? So we want to talk a little bit about what to look for in a good market. Here are some key indicators that that market is a healthy market. You want to think about job growth. Are new businesses moving into that market? More job means more people relocating and more people looking for houses. Right? So along with that, you also want to look at population growth. A growing population puts upward pressure on rent and value. What this is going to mean is that your property value is going to keep increasing. School quality. Highly rated school attracts more families. And this will also increase property demand and stability. And you have to think about crime rate. Safer areas attract better tenants. And that also supports higher property value. You're starting to hear a trend, right? You want to shoot for higher property value over time because that's why we invest in real estate. We want those property values to be going up. The next thing I want you to think about is future developments, new shopping centers, public transport, hospitals, entertainment hub. All of this signals long-term appreciation potential. The last thing I want you to assess here is rental demand. Look at vacancy rates. What are the average days on the market? And also assess rent trends to see if the properties are leasing quickly and they are leasing at a good rate, right? And you will also use that rate to determine whether or not the price will be worth it. So now that you understand what to look for in a good market, let's talk about how to research a market. There are many different tools that you can use to research the market. Some of the tools that I've personally used, use these tools to research your target area. City websites and local news. Check the infrastructure, any projects that are incoming and any economic initiatives. A lot of investors tend to overlook this aspect of the research. They quickly run into Zillow, Redfin, Realtors, but they don't take the time to actually try to understand, well, what is that city doing? What are some aspects of the city government? Because let me tell you, it makes a big difference. If your city has some big infrastructure project coming in, this could be good or bad for that property you're about to buy, right? If for some reason they are going to put a big railway close to the property you're about to buy in about 5 to 10 years, it might be good for you. However, in the near future, it might be challenging. It's up to you to understand all of those dynamics so you can make the right decision for you. So once you've taken some time to do some local research with what's happening in local city government, now we move on to Zillow, Redfin, and Realtor. This is where you study property price, trends, rental comps, right? And different neighborhood stats. Really take your time. I have built a whole spreadsheet for mine where I will go in there and I will begin to look at what are the prices like in that area, right? What are the buy prices? What are the sell prices? How has it trended? Have property values gone up? Have they gone down? I also look at rent prices. What are the trends? Take the time to really do a deep dive of all of these different numbers. Another tool that I use regularly is Rental Meter. And I'm actually going to one of these days do a tool of the trades tutorial for Rental Meter. I like this tool because it analyzes current rental rates for similar properties. This for me is one of the best way for somebody who isn't a realtor to get comps that also look professional. I have a property with the Section 8 tenant on it, and I use Rent-O-Meter every single year to send them a detailed professional report of comps that are undeniable. I was able to take my property from $1,500 all the way to $2,000 a month in a period of about 2 months because I used Rent-O-Meter to show them that, hey, other properties in the area go for $2,100. I am actually below the rate that I am requesting. They did not bat an eye and they gave me my rate increase. Another really great tool for you to use is Bigger Pockets. One of my favorite, even though I know things are changing there a little bit, but they continue to be a favorite of mine in terms of connecting with other real estate investors and also your local REI meetups. Do not sleep on networking. Real estate or any business is about connection with people face to face. Online is not enough, my friend. You need to be making those connections both online and offline. So you want to learn from investors who have already operated in that area. Start to look for investors you will personally connect with. Investors who will be willing to maybe bring you under their wings and teach you. But I want to make something very clear. You are not going to stop taking action if you don't have a mentor. You will keep going, you will keep drilling, you will keep moving forward. Okay? The last tool that you are going to be using for your research are census data. You really want to take the time, just like for city and local research, investors, especially those who are novice, tend to not think about these as tools for them to use to better understand their market. I want you to change that. I want you the person who's elevating your skill set. So you are going to be looking at census data. You want to review population trends. You want to review household income and employment sectors. This is critical. You need to understand the historical trend in the city that you are about to invest in. Some of this stuff may already be knowledgeable to you if you grew up in that city. But if you're investing in a city that you're not very familiar with, your research has to match your experience with that city. So you now understand how to research your market. Okay, so we started the whole conversation talking to you about how to research your market. You understand that once you know what market you want, the next step is finding the right property. Here are some primary sourcing methods for you to familiarize yourself with and to really develop that deep knowledge in. The first one is the mother of all property finding deal source. That is the MLS. Of course, for the MLS, you will need access to a realtor. And this tool is best for traditional home sales. These properties are often move-in ready. These are usually listed at or near market price, right? So this is now you can find deals on the MLS, but we have to be very honest. Those deals come with the caveat compared to what you would find if you were looking at off-market properties. But I will give you my 2 cents on the MLS versus off-market properties here in just a little bit. The second source will be off market deals. Think of these as you put in a lot of work to find what we call hidden gems, right? You're looking for vacant, rundown, distressed properties. This is where I am going to have to bring in that disclaimer. The real estate industry has changed. Okay. And that's just the reality of real estate. Real estate ebbs and flows. It goes up and it goes down. Around 2008, off market deals, hidden gems were all over the place. Today, the game has changed. We have to change. I have found some great deals on the MLS that weren't as good as vacant properties. For everything, there's a good and there's bad. When you use the MLS, you can get conventional financing like FHA, conventional loans, DSCR, etc. We'll link a video up here on real estate financing. But when you get off-market deals, let's be very honest, these are often hard to find because they are crappy. They tend to not be in the best neighborhoods. They tend to be really dilapidated. 10 years ago, sometimes between 2008, around the crash, and 2020, like 2018, right? Those were the golden age of this particular deal source. But today, honey, even those broken down homes are on the MLS because the market has just gone up so much. There is demand versus available houses on the market is highly skewed. So even that dilapidated house is gone. Okay, this doesn't mean that deals are not there, but what defines a deal in 2025 is very different from what defined it in 2008. I will not be the person who will come here and bullshit you. No, I won't be that person. It is harder to find these off market properties. So there are two ways that people traditionally find off market deals. There's driving for dollars, which I do not recommend for us women in corporate America. I better not find you going out there in your car and driving for freaking dollars. Your time is way too valuable. You will not be doing that. The second way to find off-market deals is by networking. So this is where you're letting friends, agents, contractors know that you are buying. And these deals will often come by word of mouth, right? Somebody who knows somebody who knows somebody wants to get rid of their house, and they'll reach out to you. You guys make a deal together. But here's the truth. Today, in the 21st century of 2025, not 2008, but 2025, even these word of mouth deals are still comparable to what's happening on the market. A lot of people who preach off market deals and all of these real estate strategies are people who lived in the 90s when the internet didn't exist. So people, unless you had a realtor, you really weren't sure what the true market value of your property was. So you could go into some unsophisticated person in random neighborhood and bully them into selling you their property $100,000 below market value. Today, they can Google it for 2 seconds and know that the property next to them was sold for X amount, right? We can't fool people in the same way that we fooled them 20, 30, 40 years ago. Today, you have to be a little bit more strategic and you have to be willing to buy certain properties at a deal that back then would have been considered an okay or a bad deal, but for this market will actually be a good deal. Wholesalers and middlemen. So we talked about the MLS, we talked about off-market deals. Another way to find deals and opportunity is with wholesalers or quote unquote the middlemen as we call them, right? These are the people who will be driving for dollars and bringing deals to you. These people will find off market deals and then they will assign them to you as the investor with a fee. But even with that fee, this property would still be a discounted property. And this would be important because what's the point of having a middleman who you are paying an assignment fee if that property you can easily find on the MLS for free? So often the people who are wholesalers, they've been doing it for a long time. They are sophisticated. They've built a big email list of investors and potential sellers. They spend their days scavenging cheap, dilapidated homes. If you're somebody who invests and who wants those types of deals, absolutely, you need to be having connections with wholesalers. And the best way to connect with them is through networking at your local real estate investment organization. A fourth source for finding deals is real estate auctions. These are homes that are sold to the highest bidders, and this was once again very popular after the 2008 crash. So many homes were foreclosed on because people bought homes that they couldn't afford. So the bank will repossess those properties, and now that gives you the opportunity to go to a real estate auction and then bid on those properties. This is a great way to build your portfolio. There are pros and cons because you are sometimes buying these properties without doing any due diligence. You do have some time to do some due diligence, but not in the same way as if you were buying a conventional loan. And there are ways that you can go bid for these homes and then go through a conventional process so you can finance the property. But a lot of people who are doing these types of deals, these are big time investors who are bringing in the cash. So when it comes to real estate auctions, foreclosures are one. The second one are tax lien. These are properties that have unpaid taxes. So you go and you usually try to purchase. And for these types of properties with tax lien, they would sometimes or almost always require full cash payment. And yeah, the risk is high, but so is the reward. I mean, that's the reality of real estate and business. The higher your risk, the higher your reward. And the people who tend to do auctions, they're very skilled at it. They've been doing it for a long time. They have the scars to show for it. They have the systems, their plans. They know how to look at property. But even they will tell you that they've had challenges, right? And I think the beauty of real estate is the recognition that with success also comes some failures. I stick to the MLS. I am an MLS girl, but I'm also not somebody who's doing real estate at the multi-million level. I am a woman in corporate America who has a full-time job, who is using real estate as a long-term investment strategy. A lot of these strategies that I just shared with you on finding a deal tend to be more attractive to people who treat real estate as a business. And so that means they are learning a lot, they are putting systems in place. So there's a lot that goes into everything I just shared that is more than just a strategy on a piece of paper. So you understand how to research your market. You understand how to find the right deal. I just gave you sources where you can go and the different ways that you can find the deals. Now let's start talking about certain metrics that have been traditionally used to measure whether or not a real estate property is going to be a good deal. You need to understand your numbers. You need to understand the matrix. Real estate isn't just about buying property. It's about building long-term wealth. And here are some key numbers every investor should understand. I'm going to share with you some traditional things on the market, and then I will give you my personal 2 cents based on my experience. Okay? The first guideline that I'm going to give you is a guideline that was popularized by Bigger Pockets almost a decade ago, or maybe longer than that, right? So the 1% rule, this is a guideline. It's a guideline, it's not a guarantee. And now that I have invested in places like Oklahoma and Colorado, two completely different markets, I can tell you this rule may have worked in the 1960s, in the 1970s, even in the early 2000s. But let me tell you something, in the year of our Lord 2025, it is very difficult. And it's not the only way to assess whether or not a property has value. But before I go into my tangent, let's talk about what the 1% rule is first. So the 1% rule suggests that the monthly rent should be equal to 1% of your purchasing price. If you buy a property for $150,000, your rent that you should get for that property should be $1,500. Now you see why I'm like, I don't know about that. This rule worked well in the year around before the year 2018, okay? However, with high market growth, like in California, this is highly unrealistic. In smaller markets, like let's think Arkansas, even where I currently am in the Oklahoma, Texas region, this is also very quickly becoming unrealistic because even in these areas, the prices have gone up. Let's say you go to some podunk little town in Oklahoma, depending on where you buy that property, you might never get $1,500 for rent. And let me also be very honest with you. The odds of you buying a property for $150,000 that you would rent for $1,500 without putting any extra cash in is very low. Even in Oklahoma, honey, let me tell you, especially today with these high interest rates. Okay? And also, I want you to understand a few things. Those lower markets where you may meet the 1% rule will also have slower appreciation. Remember how in real estate we get paid multiple ways, with appreciation being one of the main things people like myself are shooting for. I shoot for appreciation, I shoot for principal pay down, my renters paying my mortgage, and I shoot for tax benefit. The rental income is great, but it's not really what I focus on. So when you opt for the 1% rule, know that today it's very difficult. It's not impossible. It's just very difficult. You often find these deals in smaller markets that tend to have lower property values, but those markets will also have lower appreciation. Now let's talk about the second metric, that is cash on cash return. This metric will measure your annual cash flow relative to your cash investment. Remember how when I was talking about, if you buy that property for $150,000, you will have to put a lot of cash in order to get that $1,500. This is why that cash on cash return value really matters. So the formula here is your annual cash flow divided by the cash invested equals your percent return. So for example, if you invest $20,000 and you earn $4,000 per year, your cash on cash return will be 20% return. You would take your annual cash flow, which is $4,000 a year, and this is really important. By cash flow, we don't mean the rent money that came in. We mean I paid off my mortgage, I paid off the handyman, I paid off everything. What is left over? is what I divide against what I invested. Yes, when you begin to add up these numbers, you begin to see how, real estate investing numbers are rough. Some people are getting about $150 a month in cash flow. If you're only getting $150 a month in cash flow, at the end of the year, honey, that's $1,500. If you invested $50,000 and you're only getting $1,500, your cash on cash return, right? You do the math. 20% cash on cash return, you need to determine what is a good cash on cash return for you. For me, as a woman who's invested in multiple states, from Oklahoma to Colorado to Texas, I tried investing in California and I was like, nope, let my people go. This is not for me. Okay? Maybe if I had a husband and like multiple sources of income, like with the husband, I probably could have done California, but I was like, California, let my people go. It's not for me. In Colorado, I would have happily taken a 5 to 10% cash on cash return because the appreciation is bangers. Here in Oklahoma, I do like a cash on cash return of above 10%, 10 to maybe 15%. But like with anything, it's very situation dependent and you look at it holistically. Other key metrics that I want you to be thinking about is rent to price ratio. Do a quick screening. What's the price of the home and how much can you rent it for? You need to compare the cost of buying versus the cost of renting. This to me is a big number that I look at, right? And by cost of buying, I like to look at how much I am paying for my PT mortgage, principal, interest, taxes, and insurance. I look at that number. Let's say my mortgage is $3,300, right? Are there any other expenses associated with that? I like to add 20% to that. So let's say if my mortgage PT is 1,000, I add $200 for buffer. I do like to rent it for about $1,200. If I can get $1,200 for me, I'm good. Even if I don't make any cash flow, the fact that those key things are covered, Nandy is a happy woman because I am not using real estate to fund my lifestyle. I'm using real estate to fund my retirement. That is my strategy. Other key metrics, especially for people, let's say you don't have a 9 to 5 job like me. You will be doing some sort of hard money loan and then you will refinance into a DSCR. If you don't know what a DSCR loan is, a debt service coverage ratio, I will put a link here into the financing video so you can go take a look at that. This is where you show if your income covers your loan payment plus about 20% above that. So when you have a DSCR, they tend to require for you to have about 120%, whatever the PT mortgage is, right? So just like I said, the mortgage is $1,000 for principal, interest, taxes, and insurance, right? Have a 20% buffer in case of emergency. You can actually get your property funded without them looking at your income. Let's talk about the 4 ways you win in real estate. I just shared with you a lot of metrics, a lot of guidelines on how to assess the market, how to find the right deals. But these metrics do not stand alone. There are many different ways, honey, you can win in real estate. Buying a rental property gives you multiple streams of financial gains. The first one that almost everybody looks at is cash flow. This is the monthly profit after all of the expenses have been paid. For me, this number is important, but it's not that important. For some people, it's really, really important. I'm going to be sharing all of these ways of winning in real estate with you so that you can map out your strategy based on what's most important to you. The second ways of winning is appreciation. Your property value will rise over time. If you are somebody who values appreciation, then from the get-go, buy with appreciation in mind. Of course, we understand that we cannot predict where property values would go. It's so funny. When I first started in real estate, I would always get pissed off because there will be a lot of smarty pants who would tell you, well, you can't predict appreciation. But for the most part, we're talking thousands of years of history that has shown that real estate will almost always appreciate depending on the right market. This is why the beginning of this conversation, we talked about understanding your market. Knowing everything that I know, I just recently bought into a less than ideal market. And let me tell you something, your market matters. When you buy in the right market, that appreciation is chef's kiss. I buy for long term appreciation. I buy for retirement. So for somebody like me, a market where my properties would appreciate, where I my rent prices will continue to go up, even if today, let's say I'm underwater on a property, I know that in about 30 years, that property will be paid for in full. 60% or so of the rent that has gone up from when I bought it 30 years ago will be going to fund my retirement. The third benefit is tax benefits. This one, it was not really something that I had in mind, but honey, let me tell you, the tax perks when you have rental properties, double chef's kiss. You can write off depreciation, interest rate, repairs, right? All of these will reduce your taxable income. And I'm going to try to have a video specifically on the impact having rental properties on your taxable income if you have a W-2 job. The fourth way you win in real estate is with principal pay down. Your tenants will pay off your mortgage. So you are building equity. With appreciation, you are building equity, but then you're also building equity with principal pay down. So it's a two-pronged approach. When you have rental properties, you're building equity with both principal pay down and appreciation. That, honey, is the superpower of real estate. This is why very early on, I wanted to start my investment journey with real estate. And I'm so glad I started 7 years ago because today it is a lot harder. Not impossible, it's just a little bit harder. In 2017, I bought a property with 3.5% down payment, an interest rate of 3.5%, and the property I bought for less than $180,000. Today, that same property is worth almost $400,000, and you cannot buy it with interest rate less than 6.5%. All right, so it's harder today. Now, let me tell you something though. Despite it being hard, it's still one of the best investments that you can ever make. You just need to find your strategy. So, this is a series. One of my videos here in about a week or two is going to be about specifically how to select the right real estate investment strategy. Before we close out this video, I want to talk to you about two very important things. Please bear with me. Let's start about red flags to watch for when evaluating real estate properties. Not every cheap house is a deal. This is really, really critical. You need to avoid surprises by checking for the big five. You want to understand critical components like foundations, cracks, uneven doors that stick. This will be a costly fix for you. We're looking at anywhere from $5,000 to $30,000. You need to look at plumbing. Look for leaks, water stain. This could cost you anywhere from $2,000 to $15,000. Electrical. Do they have any outdated wiring? Because this could be a fire hazard, and rewiring a home could cost you upwards of $20,000. Oh, honey, I have been there. You need to look at the roof, missing shingle, any leaks, because in your roof, you're looking at upwards of 15,000, if not more. The last thing I want you to check is HVAC. You need to check the system's age. You need to check that it's functioning. And let me tell you this, when they conduct that inspection, you better be present. You better be looking. The biggest mistake I've made in my career as a real estate investor is not attending my inspections. Never again would I buy a house without being there when the inspection is happening and looking at everything, because that is how you get a little bit of money back in your pocket, and that's how you make sure that you do not have any surprises. So now let's talk risk management and exit strategy. Every investor should plan for what ifs. I'm telling you, I am somebody who, when I was investing with scarcity. I was investing in a hurry, right? I would see the opportunity to buy a house and I would just jump all in. And this almost always left me depleted. You can follow my debt pay down journey here so you can see how me taking on that approach left me completely depleted. Now, no regrets. I love my journey. I love where I have been. But I want you to have an emergency fund. You need to keep reserves of at least 3 to 6 months of expenses for repairs and vacancy. Now, for somebody like me who's a high income earner, I was able to withstand not having a lot of these reserves because my income compensated for that. But I'm definitely changing that. That is why in the next year or two, I am not investing in real estate. I'm actually renting and saving money so that I can build up my personal emergency fund, my business emergency fund, and my real estate emergency fund. And also, interest rates are so high. When I broke down all of the numbers, you guys, it was significantly cheaper to rent than it was to buy. That's another video, right? I always thought it was the other way around. I've always been, I'm never gonna rent, I'm gonna buy type of girl. Nope. Better to rent than to buy in 2025 in Oklahoma. Your exit strategy. Can you resell the property quickly if needed? Is it in a desirable area with solid resale demand? Let me tell you, as somebody who bought out of emotion a property that I really like, honey, this is important. But the reality is, as an investor, it's just part of our growing up initiation. The other thing I want you to think about for risk management is insurance. Right? You need to consider having some sort of landlord insurance or possibly an umbrella policy for added liability protection. Because let me tell you something, we're in America. America is a litigious nation. You do not know who will come after you. Here are my closing thoughts. Finding the right deal will take patience, it will take data, and it will take discipline. You need to stick to the numbers. You need to evaluate that market carefully. And always, please always do your due diligence, because with real estate, those rewards are high, but so are the risks. Remember, rental income is not the only way to win in real estate. So when you are determining what a good deal is, make it comprehensive. Assess everything: the rental income, the potential appreciation, the tax benefits, and most importantly, the principal paydown. All of this work together to build long-term wealth. Next video we are going to be sharing with you is how to finance your first property. In that module, we are going to break down how you can actually finance your deals, including the best loan type, right? How to prep your credit, and the different creative ways that you can fund your investment without draining your savings. Let me know if you like this style of videos. And also, if you would like me to create a downloadable PDF that would take you step by step on how to buy your first property or your first rental property, I'll be more than happy to put one together for you. Of course, this is only part 3 of this series. I have about 6 more videos coming up. Like I said, we are going to be deep diving and going step by step, my dears. I thank you so much for joining me in this video, and I will see you in the next one.